Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. This is Nikki Fu, Commercial Director at My Steel Global, responsible for growth strategy across our new business sectors. On June 18th, China's average domestic residential LPG price stood at 5,976 yuan per tonne, down about 200 yuan per tonne week on week. The main shift came from easing geopolitical tensions in the Middle East. Following the signing of a US-Iran Memorandum of Understanding and the lifting of the US blockade on Iran, concerns over potential supply disruptions through the Strait of Hormuz eased considerably, triggering a sharp unwinding of risk premiums across energy markets. At the same time, China's domestic LPG fundamentals remained well supplied, with rising imports and growing inventories adding further downside pressure to prices. To help us understand what happened and what to watch next, we're joined by Ibo, lead LPG analyst at MySteel Oilchem. So, Ibo, why did the market fall so much more than we had expected?
What surprised the market wasn't just the easing of geopolitical tensions, but the speed of the repricing. Once traders became more confident that the risk of a major disruption through the Strait of Hormuz was declining, crude oil and LPG markets adjusted very quickly. The geopolitical premium that had built up over previous weeks was unwound in a short period of time. At the same time, China's domestic fundamentals offered little support. Import arrivals increased, inventories continued to build, and seasonal fuel demand remained weak. That said, China's LPG market was hit by both a rapid decline in external risk pricing and growing oversupply.
And how has the international LPG market performed over the past week?
The international LPG prices also saw a sharp decline, mainly driven by weaker crude oil prices. Market sentiment turned more bearish following progress in US-Iran negotiations, with expectations that the Strait of Hormuz could reopen more smoothly, which further weighed on prices.
That has had a significant impact on China's domestic LPG market. Let's talk about supply first. How much did the supply side contribute to the bearish sentiment we saw in the market?
Supply was definitely an important part of the story. China's domestic refinery output increased slightly, but the more significant development was imports. International LPG arrivals climbed to roughly 645,000 tons, a substantial increase from the previous period. Most of those cargoes arrived in eastern and southern China, with shipments coming from the United States, Saudi Arabia, Canada, and several other suppliers. As a result, China is facing an increasingly oversupplied LPG market. More importantly, supply growth outpaced demand growth, which widened the market surplus and added further downward pressure on prices.
And what about demand? Are we starting to see any meaningful improvement there?
The picture is mixed. Combustion demand remains seasonally weak, as we've noted in recent weeks, while many buyers have stayed cautious amid falling prices, limiting replenishment activity. The more encouraging developments are still coming from chemical sector. Several downstream units either resumed operations or increased operating rates, particularly in the PDH segment. PDH capacity utilization rate moved close to 70%, providing additional support for propane consumption. Nevertheless, the improvement in chemical demand was not strong enough to absorb the increase in supply. While demand has improved in certain areas, the overall market balance remains loose.
And I assume that's reflected in inventories as well?
Exactly. Inventories continued to build across the supply chain. Producer inventories increased as weaker buying interest slowed product movement, while port inventories also moved higher considerably because import arrivals exceeded consumption growth. The market remained oversupplied, with supply exceeding consumption and inventories continuing to build.
It sounds like the market is gradually shifting its focus from geopolitics back to fundamentals. Would that be a fair assessment?
I think that's exactly what's happening. Geopolitical developments remain important because they continue to influence crude oil and international LPG pricing. But as concerns over supply disruptions ease, the market is paying much closer attention to domestic fundamentals, and right now, those fundamentals are still weak. Supply remains ample, inventories are elevated, and seasonal fuel demand has yet to show a meaningful recovery. PDH chemical demand is improving, but not enough to fundamentally change the broader market balance.
That's what we've been experiencing recently. So, looking ahead, what are the key factors the market should be watching?
The Middle East remains the most important variable. If US-Iran negotiations continue to progress and shipping conditions through the Strait of Hormuz normalize further, additional risk premium could be removed from both crude oil and LPG prices. At the same time, market participants will be watching whether improving demand in the PDH chemical sector can continue to offset some of the supply pressure, particularly as PDH operating rates move higher. In the near term, there is downside risk to China's LPG prices, estimated at around 100 yuan per ton. Import arrivals are expected to ease from the recent peak, which may provide some support to market balances. However, supply remains ample overall, while fuel demand stays seasonally weak, with chemical demand showing relatively better performance. Taken together, the market currently lacks a strong bullish catalyst, and near-term downside risks continue to outweigh upside drivers.
So, the key takeaway is that the market is moving away from geopolitical risk pricing and back toward fundamentals. And for now, those fundamentals still point to an amply supplied market, rising inventories, and only gradual demand improvement. Ibo, thank you for joining us today, and thank you to all our listeners for joining us. If you'd like to follow these developments in more details, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LPG Market Weekly Report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.